Okay, let's just jump right into this explainer. Today, we're looking at a massive, real-world puzzle. It's affecting millions of people, it's reshaping our entire economy, and honestly, it's completely defying traditional financial logic. We call it the paradox of the missing houses. Now look, if you've browsed real estate listings lately, or if you're out there trying to buy your first home, you already know something is structurally way off. But today, we're going to actually dive into the data to show you exactly why this is happening.
Get a load of this number, 75%. That is the chunk of U.S. households that are now entirely priced out of buying a medium-priced new home. Just let that sink in for a second. Literally 3 out of every 4 families right now cannot afford what is supposed to be your average, middle-of-the-road starter home. And we're not just talking about luxury markets in places like New York or San Francisco. Now, this is a nationwide phenomenon. It represents without a doubt the absolute worst level of housing affordability we've seen in decades.
Which brings us to the central economic paradox we've got to unravel today. If mortgage rates are up, why on earth aren't home prices going down? Usually in economics, gravity works, right? High interest rates are supposed to crush asset prices. When it costs way more to borrow money, buyers just can't afford to pay as much. So naturally, sellers have to lower their asking prices. But this time, the market is completely defying gravity. No way around it.
So let's get into Section 1, the housing affordability paradox. To really understand this crisis, we kind of have to treat it like a crime scene and look at the sudden aggressive spike in borrowing costs. Take a look at that green line right there. That represents the 30-year fixed-rate mortgage. For years, you can see it was just hovering at these historic lows. But then, look over at the right side of the chart. You see that massive, almost vertical climb? Yeah, we went from mortgage rates of around 3% back in 2021 to over 7% by 2023. In the span of just a couple of years, the cost to just borrow the money to buy a house effectively doubled. Now contrast those soaring interest rates with this chart, which tracks actual home prices. Logically, as that green line we just saw shot up, this dark blue line representing home prices should have totally dipped. But instead, home prices essentially ignored those rate hikes. They dipped very slightly, sure, but then they just kept marching right back up to near record highs across most of the country. And that leaves today's buyers facing literally the worst of both worlds. You've got these elevated, premium home prices combined with incredibly expensive mortgages.
Section 2, Era of Easy Money.
So how did we even arrive at this paradox? Well, we have to trace it directly back to the Federal Reserve's actions over the last couple of decades. Back in the early 2000s, rates were cut to just 1%. Then, following the 2008 financial crisis, the Fed launched quantitative easing, buying up a massive $1.25 trillion in mortgage-backed securities, or MBS. Fast forward to 2020 and 2021, and rates went right back down to zero alongside another $1 trillion in MBS purchases. Neutrally speaking, the mechanics here are pretty straightforward. By injecting unprecedented liquidity and buying up all these mortgage bonds, the Fed successfully stabilized the banking system. But mechanically, this also artificially expanded the pool of eligible buyers and significantly inflated asset values over time.
And that leaves us with what we can call the overhang. Today, the Federal Reserve still holds roughly $2.3 trillion in mortgage-backed securities right there on its balance sheet. Now, the Fed is being highly cautious about unloading these assets because dumping them could rapidly push mortgage rates even higher and, risk completely crashing the housing market. But the catch is, by holding on to them, they are effectively still subsidizing housing demand and keeping those asset prices propped way up. Moving on to Section 3, the mortgage lock-in effect.
This brings us to the prime suspect for our missing housing inventory. If prices are so high, why aren't people just selling? Well, mortgage lock-in happens when elevated mortgage rates actively discourage current homeowners from moving. Think about it. Selling your house and relocating means giving up your current mortgage and triggering a reset to much, much worse financial terms. Let's just empathize with the human decision here for a second. Nobody wants to voluntarily trade a rare 3% mortgage for a 7% one. I mean, if you have a $300,000 loan, your monthly payment jumps from around $1,700 a month to $2,300 a month. And that's just for the privilege of moving to a similarly priced house. It just makes moving financially irrational.
Now, what's really fascinating here is the direct visual correlation of this exact lock-in effect. Look at the chart on the right. This shows the gap between the super low rates people locked in years ago and the high rates of today. You can see that gap has just visually exploded. And then, right on cue, look at the chart on the left. The monthly supply of property listings has absolutely cratered. Basically, as the financial penalty for moving went up, the supply of available homes for sale completely choked off.
Section 4. Who is actually buying?
Okay, so with supply severely choked off,
who is actually able to transact right now? Like, who is successfully navigating a market with record prices, record rates, and basically zero inventory? This chart breaks down transactions by buyer type, and the divergence is wild. Draw your attention to the dark blue line. That represents financed, arm's-length buyers. Everyday people trying to buy a house with a standard mortgage. As you can see, it has experienced a steep, dramatic drop. But look just below it at the green and red lines. Those represent cash buyers and non-market family transfers. And those lines? They remain stubbornly steady. The housing market hasn't stopped entirely. It's really just stopped for regular folks who rely on financing.
Let's look at the actual demographic fallout here, because we are looking at a generation fundamentally stuck. Across the country, renting is now significantly cheaper on a monthly basis than buying the exact same property. Overall affordability has declined 45% over the last decade. The median age of a U.S. renter, that's risen from 36 to 42. And here's the real kicker. To match the exact purchasing power you had back in 2019, the typical household would need an $18,000 raise today. Basically, first-time buyers are just being pushed out indefinitely.
Which brings us to Section 5. Will lowering rates help?
The conventional wisdom out there is that we just need the Federal Reserve to cut interest rates to fix this whole crisis, right? The assumption is that lowering rates will unlock the market and finally bring down those monthly payments. But will it? The crucial point here is a major plot twist uncovered by a fascinating working paper from the Philadelphia Fed. They studied the exact behavioral elasticity of both buyers and sellers. And they found something surprising. Buyers are actually far more sensitive to mortgage rates than sellers are to the lock-in effect. So what does that mean in the real world? It means a drop in rates is going to excite buyers a whole lot more than it motivates locked-in sellers to actually pack up their lives and move. And that leads to what we can call the rate cut illusion. According to the search and matching models in that Philadelphia Fed paper, here's what actually happens if rates drop to, say, 5%. Yes, step 2, some unlocked sellers will slowly start to enter the market. But step 3, a massive wave of pent-up buyers will flood the market immediately. Because that buyer demand vastly outpaces the tiny trickle of new supply, the net result in step 4 is that the market paradoxically becomes 25% tighter. Lower rates would absolutely increase sales volumes, but they would not relieve the underlying shortage or actually bring down prices.
Even the chair of the Federal Reserve recognizes this structural trap. As Jerome Powell himself stated, people are locked in. They can't afford to get out of their house because the cost of getting into a higher-priced mortgage would be a lot. It perfectly summarizes the grim reality we're facing. There is just no quick, painless policy fix to this structural imbalance. Years of easy money built a highly complex trap, and simply turning the dial back down on rates won't magically undo the supply shortage overnight.
Which leaves us with this final thought to really consider today. Is the American dream of homeownership merely delayed for this generation, or has the fundamental concept of property ownership in the U.S. been permanently altered? We've got a market completely frozen in place, where regular buyers can't enter and current owners just can't leave. So how long can this paradox last before the entire landscape of housing shifts forever? Thank you so much for watching this explainer, and we'll see you next time as we continue to break down the system shaping our world.